All right, everyone, welcome back for ratio analysis. All right, so you've thought about what interest rate you need to hit, um, or what a good return would be. You've computed the expected yield and the expected dividend yield based on what you care about, right? If you care about long term growth, you're going to look at yield. If you need income, yield, but also you're going to look at the dividend yield. But how do I know if that is a good firm? If I have any issues I need to worry about in the road ahead? Well, we can look at ratios. I'm going to talk about four. There are many. There are more in your book than this, um, and certainly a investor will look at perhaps many more than this, but we'll get a feel for it. These are four important ones I feel. So, net profit margin, return on equity, debt to equity ratio, not in your text, only here in my lecture. So you can also look it up online and find some resources there as well too. And price to earnings ratio. These are all ratios of firm financial information that help summarize firm health for us. And we're going to look at it through the lens of McDonald's. So let me get them pulled up. Let's also get Wendy's up here for comparison. So I'm using Yahoo Finance. You guys are going to use Yahoo Finance in your workshop. Um, and it holds a wealth of information about firms. All right, so there's McDonald's, and Wendy's should be loading at some point. There we go. Okay, cool. And the third thing I'm going to reference is this spreadsheet called that where I've downloaded a bunch of industry financials. And so what's going to be important about firm ratio analysis is when we compare firms using financial ratios, it doesn't make sense to compare firms across industries because they're just going to be too different, right? The ratios will differ just because they do different things. So what we really need to do is if we're trying to pick a stock, and we're thinking about firms in two different industries like manufacturing and food, then what we want to do is compare the firms to their industry averages to see if they're doing better than the average firm in their industry. And that's going to give us a much better measure. So that's what I have here. And so that's what we're going to work with. So ratio analysis. First thing, net profit margin. This is net income over sales. And so if you think about what this does, let's take a look at it for McDonald's here. Here's McDonald's. I can find under financials the different balance sheets of the firm, the income statement, the balance sheet, the cash flow. Sorry, the different spreadsheets of the firm. So income statement, balance sheet, and cash flow. And I can set them to annual or quarterly. But if we look here, this last year ending December 31st, 2016, McDonald's had sales revenue of 24 621 900, and these are in thousands too, so you add more zeros there, so that would be thousands, millions, billions. $24 billion in revenue last year. But then you have to take out all their costs and everything, the debt expenses, and we get down to a net income of $4,686,500,000. And so what the net profit margin measures is how much of that revenue is left over in profits, and it gives us an idea of how well the firm is managed, how well it manages its costs. So one firm that has a large amount of revenues but only a small amount of net income is really high cost. They're not being very efficient. But a firm that has a lot of sales and a lot of net income, they're being really efficient at turning those sales into profit. And so we could look at McDonald's. If we come over to statistics, you could find the net profit margin of 19.58%. If we look at Wendy's, we can do the same thing. Wendy's has a profit margin of, where am I? valuation, profitability, 9.43%. So McDonald's looks like they're doing a whole lot better than Wendy's is on profit margin. Compare them to the industry. What we can do here is come over to the data filter, and we can search. What you're going to be doing in your lab is basically finding restaurants. So we can't. I don't have the financials for fast food, but broadly restaurants. And so net profit margin is 7.5%. Now I'm making a little bit of a flaw here, and you're going to do better on your workshop. But this is for the most recent quarter, and what I was looking at was for the whole year. And so you're going to have to compute the profit margin yourself. You're going to have to compute the profit margin yourself using the firm financials. So using revenues and using their net income. Okay, profit margin, how well the firm can manage costs. Return on equity, kind of the same thing. Not the same thing, but kind of similar. Net return on equity, you take the net income and you divide by total stockholders' equity. And so what this measures is how efficiently the firm can take a dollar from an investor and turn it into profit. And so the idea here is that firms that have a large net incomes and do it with a little bit of money, right? If they have a few investors, they're really strong. So I have a video to illustrate this.
Return on equity is a measure of how efficient a company is at generating profits. Mike has to decide which company to invest in. Both Al's Ice Cream and Ed's Carpets earned $50 million this year. Each company has equity, the amount of cash received from the original investors in exchange for shares. Al's has equity of $100 million. Ed's has equity of $250 million. To calculate the return on equity, or ROE, Mike divides each company's profit by the equity. Mike finds out that Al's has an ROE of 50% and Ed's only has an ROE of 20%. Ed's Carpets had more equity to work with, but it produced the same profits as Al's Ice Cream. Put another way, Al's matched Ed's profits, despite the fact that it had less to work with. This suggests Al's is more efficient at generating profit from its equity. A good return on equity is attractive to investors. Mike goes to his stockbroker and buys shares of Al's Ice Cream. But no single measure can tell.
So do you see any problem with comparing Al's Ice Cream to Ed's Carpets? It's not in the same industry, right? But at any rate, I like what he said, that they both create the same net income, but one is doing it with a lot less investment dollars, so they're much more efficient. If you want to get an idea for that, come over to statistics for McDonald's, and here we go. Return on equity, 521.4. Holy crap. 521.4%. We look at Wendy's. They're sitting around 20.12. And if we look at the industry financials for restaurants, for return on equity, around 24.8. So McDonald's is way up there. And we're going to see what's going on here in a minute. But McDonald's has a huge return on equity for the investor. And it's important, though, that the stockholder or the investor looks at the debt to equity ratio alongside with the return on equity. And the reason is total stockholders' equity is total assets minus total liabilities. So whatever the firm buys assets by either borrowing or taking money from investors. So they can borrow a whole lot and have very tiny stockholders' equity. And when you do that, you can have a lot of funds creating a lot of income, right? So we call these firms leveraged, right? They use a lot of liabilities and not so much shareholders' equity to generate income. The problem with this is, for stockholders, is that firms must pay debts before shareholders, right? There's a legal obligation to pay bondholders and to pay the firms that they've borrowed from. If you are a stockholder, there's no legal obligation to pay you. You're taking on the risk of owning the firm. So if you look at a firm's debt and they're highly leveraged, you have to be comfortable with the risk that you might not get paid if the company becomes tight and needs to pay for their liabilities. So what we look at is the ratio of total liabilities to total stockholder equity to see how many dollars we have from debt versus how many dollars we have from stockholder equity. And so this can be very enlightening. And in fact, I didn't know this when designing the lecture, but if we go to find McDonald's return on equity, or sorry, not return on equity, debt to equity ratio, it doesn't exist. You can't find it. Wendy's does. And so if we dig a little deeper, let's go to the financial statements. This is a balance sheet item, liabilities and assets, just like your personal balance sheet. We see that McDonald's has total liabilities of 33, 228, 200 thousands, right? So 33 billion, but negative stockholder equity. And so that's the reason why they have an NA for their debt to equity ratio. Is technically what this means is if the company went under, stockholders would have to owe McDonald's for would have to pay to settle the bill for McDonald's because the assets minus liabilities don't balance. So McDonald's doesn't look too healthy when it comes to debt to equity ratio. Wendy's, on the other hand, right, they were lower across all the other margins, but they have a debt to equity ratio in the most recent quarter of 486.37. And if we look at the industry average, that's actually quite a bit below the debt to equity ratio for this industry. So they're not very leveraged and they're doing pretty good. Wendy's is, at least against the industry. And then the last thing we'll look at is the price to earnings ratio. So net profit margin, return on equity told us about how well the firm is managing their costs, how well they're managed. Debt to equity told us how leveraged the firm is and how risky it might be to count on them to be able to pay their liabilities and me, the investor. Price to earnings ratio is a measure of stockholder or investor sentiment. So what do investors think is going to happen to this company? The PDE ratio is the market price of the stock divided by the earnings per share. Earnings per share is just like it sounds. Take the net income of the company and subtract out preferred dividends paid, and what you have left over is earnings that can go to your common stockholder. So you take the number of shares outstanding and divide it into that, and you get earnings per share. And the reason why this PDE ratio works out is if a share of a McDonald's, for example, gave you $20, would you pay $22 for it? Well, you might say no. Why would I pay more for something than it's worth? Well, what if you expected McDonald's stock to grow? Then maybe you would pay more. And that's why the PDE ratio measures investor sentiment. If price is currently above earnings per share, investors are going to think that the earnings per share is going to grow. And so they're going to be willing to pay a little bit more for that stock. If you see a PDE ratio that is large, then we're thinking that this company is going to grow. And so we can look at these things as well. The industry P/E ratio is 38.6. So the price is 38.6 times the earnings per share. And then, of course, we could go check out McDonald's. See if I can find it. Trailing P/E ratio and forward, this is a projected price to earnings about 21 times. So McDonald's is actually below industry average in terms of how much growth they're expecting. If we go look at Wendy's, Wendy's is at 32.49, 28.11. So investors are a little bit more sweet on Wendy's than they are on McDonald's. So these are 4 simple metrics that you would use. You might use many other to kind of consider which stock to purchase. But this is exactly what you'll be doing on your workshop. The very first thing you'll do is, well, we're going to do Domino's Pizza and Papa John's. You're going to collect their financial information and compare them. Then I want you to compute their approximate expected yields using the last 2 years of data and get an idea based on yield and based on ratios, which firm kind of looks better. All right, and that's today. That is day 1 of module 3. I will see you tomorrow.